Okay, class, you are welcome back. I guess we have to get to work immediately. It's 8:30. So, still on ratios, on past questions, we're solving November 2024 in the last period, and we're asked to compute these ratios for ORAC Nigeria Limited, which we have done for 12 marks. And now we are to analyze the financial position and performance of Oracle Nigeria Limited for the year ended September 30, 2023, and determine if Datamatics PLC investments in Oracle Nigeria Limited will be worthwhile. So from the ratios we have computed, we can easily analyze the position and performance. And the easiest way for you to do it when they ask you to analyze is just for you to speak to each of the ratios you have computed. Because when they talk about analyzing position, what you will be looking at are the ratios that has to do with liquidity ratio, solvency ratios, majorly those two. Those two we talk us through our position, while performance we look through profitability ratios and efficiency ratios. So in terms of what we want to look at today, in terms of this analysis, then for performance, we'll be looking at the gross profit to capital employed. We talk on performance because the profitability ratio. The same thing with the pre-tax profits to capital employed, the gross profit margin, the net profit margin, asset turnover, collections period, payment period, inventory turnover in days, revenue per employee, dividend cover. So all of those from ratio 1 to ratio 10 speaks to the performance of this company. While current ratio and quick ratio, that has to do with liquidity, those two will speak to the financial position of ORAC Limited. And basically, you would see that you have 8 marks. You have 8 marks. So in analyzing this ratio, you don't have much time in the exam. So what we really need you to do is for you to be able to identify whether there is an improvement or a decline, and you link it to performance and position. If there is any context given in the question, which in this case we have very little, except for the fact that we want to, a company wants to buy us and they can see that we are doing very well. Aside that, there is really so much of a context. However, we were given industry average. So it is on the basis of this industry average that we are going to know whether this company is actually doing fine. So it's really not a big deal, but let's see how we can do this analysis without spending so much time on it. So we're looking at analysis of financial position and performance of ORAC Nigeria Limited. So the following paragraphs, I just want to do an introduction. Use the ratios computed above to give insights into the financial position and performance of ORAC Nigeria Limited. So that's an introduction. Then I quickly look at my ratio. I look at gross profit margin, gross profit to capital employed, pre-tax profit to capital employed, gross profit margin, net profit margin. To a large extent, gross profit to capital employed and gross profit margin, they're basically speaking of very close to the same thing. While gross profit to capital employed is looking at how much gross profit you have made on the capital invested by the shareholders. This one also speaks to the gross profit you have made on every sales. Both of them are basically impacted by your level of sales and gross profits. The same thing applies to pre-tax profit to capital employed and net profit margin. They are speaking of the same thing to a large extent. Yeah, this one is talking about return to shareholders or providers of capital. This is talking about how much profit you made on every sales. Both of them are heavily impacted by management of your costs, your overheads to be specific. So I'll just put the two together because similar. So let me look at the industry average. So for the gross profit to capital employed, we don't have industry average for that, so quite difficult. But I have industry average for pre-tax profit margin, and I have pre-tax ROCE, okay? I have pre-tax ROCE, so that's the pre-tax. Okay, good. So these two would work. These two that I can use these two as a basis for my comparison. So pre-tax to capital employed, that's this average pre-tax ROCE. Then I can compare that to industry average. And I have net profit margin, which is this pre-tax profit margin. Oh, so let me do the comparison. So I can see that the pre-tax profit to capital employed of ORAC Nigeria Limited is 18%, while industry average was the industry average, while industry average is 13%, isn't 13%. This shows that the entity makes more profits on every sales than most entities within its industry. Also, the net profit margin of ORAC Nigeria Limited is 5.4%, while the industry average is pre-tax profit margin 5.1%. No, this notation shows that the entity makes more profits. No, not that. Shows that the entity gives more return to its providers of capital. Provider, but that's pre-tax on than most entity we know. Yeah. Why the industry? Okay. So this shows that the entity makes more profit on every sales than than most entities within its industry. So additionally, 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 its asset turnover. Let me see if they give us that of industry. No, we're not given. Additionally, the entity has an asset turnover of 2.7 times, indicating that it can convert its assets to sales almost 3 times. So then we have receivable collection period 22 days, payment period 64 days, inventory turnover in days 61 days. Let's see. They give us industry? Okay. Okay, so for industry receivable period is 78 days, and he is doing 22 days. So furthermore, the entity is able to collect its receivables quicker than most entities within its industry, as it does it within 22 days, while others are doing almost 76 days. Similarly, let's see payment period, 64 days. What's the industry doing? Industry does 34 days. Yeah, industry does 34 days and is a profitable company. So similarly, the entity being a profitable company, judging from its profitability ratios, is able to negotiate a favorable term, credit term with its suppliers, as it does 64 days, while others are required to settle up within industry is doing like 34, yeah, 34 days. Right. Finally, the entity has a current ratio and a quick ratio of 1.7 ratio 1 and 0.73 ratio 1, 1.7 ratio 1, and 0.73 ratio 1, respectively, indicating that it has sufficient liquid assets to settle its short-term obligations, though its asset test ratio is a little shaky, as it cannot cover it one-to-one. Okay, but considering its efficiency and profitability, it shows that the shortfall in the asset test ratio might not be such an issue, particularly with its revenue per employee of how much is it doing? It's doing 4092 million, 4092 million, while other while others are doing, what's the industry doing? 2313. So this clearly shows that it has highly efficient workforce. Following from the above, ORAC Limited is an efficient company, is an efficient and a profitable company with a stable liquidity. With a stable liquidity. with a stable liquidity. They said determining if limited rewards were. Hence, hence, the investment of Datamatics in Oracle Nigeria Limited will be a worthwhile investment. Okay, so that's our simple analysis, just taking it strategically. So I just try to speak around the profitability ratios, just speak within the context of what I have, the ones I can compare with industry, the one I cannot, I just speak to it based on our knowledge of that ratio. And particularly, I didn't forget to mention revenue per employee because that's critical. The guy can do 4,092 revenue per employee, and others are doing, it clearly shows that it's workforce, they have very efficient because they are doing times two of what other companies are doing. So, which is quite impressive. So that's the solution to this question of November 2024. So that was not the only question they asked in November 2024. They also asked another one. They also asked another one. So, and the second one, yeah, can you read for us, Shidera? Let's look at another ratio they asked in the same diet.
Oh, still November 2024.
Yes.
Okay, another one. The ISB framework states that several measurement bases are used for the elements in financial statements. Explain the following basis of measurement. I, historical cost. II, current cost or current value. III, realizable value or settlement value. IV, present value for 5 marks. B, the following information was extracted from the statement of financial position of Wadi PLC, a company newly quoted on the Nigerian Exchange Limited. All figures raised in thousands are assumed to be correct. Okay. A financial analyst interested in investing in the company computed the following ratios in respect of the company for the year ended December 31st, 2022. Gross profit margin to be 25%. Net profit slash margin to be 20%. Inventory turnover ratio 10 times. Net profit slash equity to be 20%. Equity to current liability to be 50%. Non-current assets slash equity to be 5:4. Non-current assets slash total current assets to be 5:5. 5:7. You are required to prepare the statement of financial position as at December 31st, 2022 for 7 marks and the statement of profit or loss for the year ended December 31st, 2022 for 4 marks, total 15 marks.
Okay. So the A part was for 4 marks. So they wanted you to explain the following: historical costs, current cost, realizable value, and present value. So I really want you to write this down in your notes and as your assignment. Make sure you try it. I've taught you these definitions before. You go and check when we did conceptual framework. we speak to each of these. So, and also present value is very similar to value in use. That's what we call value in use. So write it down. Make sure you do that. It's 4 marks. Then the B part. So this particular question, they give us extracts of statement of financial position of a newly of a company that was just quoted on the Nigerian Stock Exchange. So they gave us its total non-current assets at the end of the year. They gave us its closing inventories. And also, they were told that the financial analyst interested in investing in the company computed the following ratio in respect of the company. So somebody computed this ratio. You are now asked to prepare an account. So yeah, now this is like the opposite of what they have been testing. Normally, they will give you account and ask you to prepare ratio. Here, they gave you ratio. You are now asked to prepare accounts. So how do we then go about this? And it's just how many marks? Just 11 marks. 7 marks here, 4 marks here. So how do we go about this? They give us gross profit margin. I can see they give us total non-current asset and closing inventory. So my starting point is to look at what can I do with these figures? Which ratio uses non-current asset and closing inventory? Um, so gross profit margin, no. Net profit margin, no. Inventory turnover ratio, yes, because it uses closing inventory. Net profit margin to equity, equity to current liabilities, non-current assets to equity. Okay, so I can easily get equity from here first. I can get my equity. I can get a lot. So let me start with my workings. So my non-current assets slash equity ratio, I was given as 5 to 4. Okay. So let me express it this way. All upon equity equals 5 to 4 means 5 all upon 5/4. That's what 5 to 4 means. 5/4. So they already gave me non-current asset as 50,000. So I have 50,000. Okay. All upon equity equals 5/4. So if I should cross multiply, 50,000 times 4,000 is 200,000 equals 5 equity. So if I should divide through by 5, my equity is 20,000 divided by 5. And what does that give us? What's
40,000.
Okay, that's 40,000. So my equity is 40,000. So I've gotten equity. I can also quickly get my total current asset as well by using, let's say this is 1. So by using my non-current assets to non-current assets to total to total current assets equals 5/7. So I already know that my non-current asset is 50,000. I don't have total current assets. So that's equals 5/7 by cross multiply. That would be 350,000 equals 5 total current assets. Okay, so if I should divide through by 5, my total current assets will simply be 70,000. Okay, so I've gotten another figure. Then from here I can get my current liabilities using equity to current liabilities. So equity all upon current liabilities equal to 50%. That's 0.5. So I already got my equity up there as 40,000. So 40,000 all upon current liabilities equals 50%. So if I should cross multiply, 40,000 equals 0.5 current liabilities. So if I divide 2 by 0.5, current liabilities equals, if I divide 2 by 0.5, current liabilities equal 40,000 divided by 0.5. You agree with me that is 80,000. All right?
Yes, sir.
Okay. So I've gotten that too. So my account is gradually getting ready. Also, I can get my net profits from here because net profit to equity, they said is 20%. So net profit over equity equals point what? 20% equals 0.2. So I don't know my net profits, but I know my equity. I got my equity as 40,000 up there equals 0.2. If I should cross multiply, net profit equal to 0.2 times 40,000. That's simply 8,000. So I've gotten net profit too. Going forward, I can get sales from net profit margin. I can easily get sales for my net profit margin. So net profits over sales. Net profit margin, you said is 20%. That's 0.2. So I already know my net profits to be 8,000. I don't know my sales. I know this is 0.2. So if I cross multiply, 8,000 equals 0.2 sales. So I should divide two by, or I should divide two by 0.2. So what will be 8,000 divided by 0.2? That's 40,000. I've gotten my sales. I can get my gross profit from here. I can get my gross profit from here. So gross profit margin, which is gross profits over sales equals gross profit over sales equals 25%. So what's my gross profit here? I don't know. That's what I want to get. But I know my sales. My sales is 40,000 equals 0.25. If I cross multiply, my gross profit is simply 10,000. So from here, for this company, what's the name? They didn't tell us. Okay. For this company, I can easily prepare a statement of profit or loss for the year ended December 31st, December 21st, 2022. I already got their sales to be 40,000. Then my cost of sales, I don't know. But since I know my gross profits, it will be 10,000. Definitely my cost of sales is definitely 30,000. Then my operating expenses, I don't know, but I know my net profit. Since I know my net profit, what's my net profit? My net profit from here is 8,000. So I know that my operating expenses is definitely 8,000. Then I can do my statement of financial position as at year ended December 31st, 2022. Under my assets, I have my total non-current assets. I was given my total non-current assets as, they gave me as 50,000. I was given my total current assets. I got it somewhere as 70,000. So I have a total assets as 128,000. Then My equity and liabilities. I have my equity up here. What's my equity? I have my equity as 40,000 from what we have here. Then I have my liabilities, but to be specific, I think they gave me, I could calculate current liabilities from here as 80,000. If I sum them together, you see that your account will balance. Total equity, liabilities gives you 120,000. So to a large extent, I was just being smart to work around this. I didn't even use this closing inventory at all. I was just working around the marks available, 7, 4. I mean, I could decide to, from this, since I'm given closing inventory, I could go a long way. This inventory turnover ratio, I didn't touch it at all. I was able to get my sales in another way, but um, I mean, I know that their intention might be me using average inventory so that I'll be able to get opening and closing inventory. Opening and closing, and it's a long thing. Not really a long thing, but it's a much more difficult approach, and it might not really guarantee me so much of a mark. Because for us, with this I've done, I've been able to get all the key elements because I could easily get my cost of sales as balancing figure since I have my gross profit. So why spend so much effort getting opening and closing? Doesn't really account to so much. So reason why it is left out. So that's that for this question. Okay. So in case you hear people talking about work back of ratios, that is it. It was asked before in November 2024. If you see it again, you should know how to approach it in your exam. Now let's go to May 2024. Let's go to May 2024. Shidera can read.
Badagry PLC statement of financial position as at March 31st, 2021. We have 2 years here, 31st March 2021 and 31st March 2020. All figures raised in thousands assumed to be correct. We also have our statement. Okay, require. You are required to discuss the profitability. Okay, we also have our statement of profit or loss for the year ended March 31st, 2021. All figures raised in thousands assumed to be correct. Required. You are required to discuss the profitability, gearing and investors' stake in Badagry PLC and recommend strategies for improving or sustaining them. 10 marks.
Okay, so for this one, the examiner was very straightforward. He just said you should discuss profitability, gearing, and investor stake. So to discuss profitability, you cannot just be talking about profits, that the company made a profit of this. That will not account to so much. And knowing fully well that they give you just 1 year statement of profit or loss, so you would really need to compute some ratios and some key ratios to compute. You can compute three ratios so that you can, because they didn't give you anything to compare with. You can compute gross profit margin. You can compute operating profit margin. You can compute operating profit margin, and also you can do two ratios is better. You can do ROCE, return on capital employed, and compute two ratios because gross profit, net profit, ROCE, return on capital employed, and operating profit margin would be looking at the same thing because they are all determined by costs, the cost of the company. So those two ratios will help you take care of discussions on profitability. Then for gearing, you compute two ratios for that. You would compute gearing ratio, debt over debt plus equity. Then you would also compute interest cover. Interest cover is a major one, which is PBIT. PBIT over interest. Then if investor's stake. Investor's stake is similar to proprietor's ratio. It's just you looking at what does the investors have in the business, and from what I can see here, on using trend analysis alone, equity has improved, has almost doubled from 269 to 560. It has almost doubled. So investor stake in the business is obviously progressing. So, because it's much of 10 marks. So you really need to know what you're doing. You don't just start computing ratios aimlessly that are really speaking to the same thing, because the examiner was direct. He said discuss. Ordinarily just discuss and move on, but you need to compute few ratios. So my workings, if I do gross profit margin, which we already learned is gross profits all upon sales times 100. And what's my gross profit? 268. What's my sales? 490 times 100. What does that give us?
%55.
Sorry?
55%.
55%. Then my return on capital employed is, I can use, let me use PBIT. PBIT, or call it profit from operation, over capital employed, and let me use equity plus debt. So what's my profit from operation? That will be PBT, which is 286,500. PBT dividend received. I need to remove it back. Plus, I need to add back this. Equity plus debt. My equity is 560, debt 50. 560. 50. So just give me the final answer.
Sorry, the first number. Hello, sir.
Yeah.
The first number 285. It should be 286.
Thank you. 286,500. Okay, so what do we have?
%27%.
Now, I think it's also useful for me to know exactly what did I return to my equity, which is profit for the year, all upon equity alone. Of course, times 100. And my profit for the year is 216,500. All upon equity. Lincoln, you can ask a question.
So, for the profits from operation, I knew the 153,500 was the dividend received. What was the 5,000, sir?
The finance cost.
Okay, thank you, sir.
Yeah. So how much is this?
Hello, sir.
Yes, share.
The 27%, I have 22.6. I'm not sure it's 27.
Please, let's confirm. 22.
Someone can confirm as well. 20.6.
Yes, it's 22%. 0.22.
0.22. Okay. Thank you for the correction. So what about this?
$38.66. That's
38.7. 38.7. So this is enough to speak to profitability. Then for gearing, I will compute gearing ratio, which is debt, interest-bearing debt over debt plus equity plus times 100. So what's our debt? 50,000. What's equity? So how much?
$8.2.
And 2. So interest cover which is PBIT or profit from operation, all upon your finance costs. We already computed profit from operations. So what did we get from up here? Just give me the final answer so that
27.6.
okay, so let's discuss this. So I want us to talk about profitability, gearing, and investor stake of Badagry, and recommend strategy for improving in Badagry. So the gross profit margin of the company is 55%, which shows that it makes 55% on every sales made, on every sales. For us, this indicates that the company manages its cost of sales very well. Additionally, it has a return on capital employed of 22%, which shows that it gives its providers of capital 22.6% return on their investments. This also indicates that the entity manages its operating expenses very well, though when compared with the gross profit margin, and suggest that the company have a room for improvements in the management of its overhead. Considering that it does it costs let me not confuse you guys. Considering that it does a gross profit margin of 55%. So if you can do GP margin of 55%, which shows that your cost of sales is just 45%. All right. So we believe that you should do better. We can do better, we'll see. Okay. Similarly, the return to equity holders is 38.7%. 38.7%. Though a major component of this income is dividend received, which might not reoccur in future periods, So the entity can or should improve in the next year, where it might not receive dividends. So, because if you look at their P&L, a major part of these profits is this dividend received. If you take away this, it's really not so good. If you take this away, what is remaining is minimal. So that's what we're actually speaking to there. So that's as regards profitability. Then we have to talk about gearing. The gearing ratio of the company is 8.2%, which shows that it is lowly geared and has an insignificant financial risk. Additionally, it can cover its finance costs 27.6 times, indicating good profitability and stability. Its investor stake has improved by, I want to do a trend analysis from 269 to 560. If I do 560 minus 269 divided by 269, that's over 100%. Over 100%. By over 100% from year to year. showing a strong proprietors holding in the business. The entity should sustain the investments that gives it a huge dividend received. However, it should also improve its operating activities so it can make improved or additional profits from operations. Finally, it should imbibe cost management strategies to improve its underlying profitability. Okay, so that is for this May 2024. That's for this May 2024. Now, they asked another May 2024 again, but this is too similar to what we have been doing. So I will give you this as another assignment, making two second assignments. Let's try it so that I can share this. I would share the solution with you, but I will not put the solution when I'm sending the note. I just want you to try it. They just ask you to calculate these ratios. We have calculated it over and over again, and they said you should make comments. Okay? So when they say make comment, just the same way I've been making those comments. So make comment on each of these ratios. Speak to each of them. Like that, like that, like that. And you are doing for 2 years, so you can easily compare from 1 year to another. So let's do November 2023. Let's do November 2023. Okay, Shidera, are you still there?
Yes, sir. Mhm.
Let's read it, please.
Okay. Chisom PLC experienced rapid growth in recent years through the acquisition and integration of other companies. Chisom PLC is interested in acquiring Oyowood Limited, a retailing company which is one of the several companies owned and managed by the same family. The summarized financial statements of Oyowood Limited for the year ended December 31st, 2022 are as follows. I think we are giving 2 years statement. If not, I know. Okay. Also have a statement of financial position. All four figures are assumed to be correct. Okay. From the above financial statements, Chisom PLC has calculated for Oyowood Limited the ratios below for the year ended December 31st, 2022. It has also obtained the equivalent ratios for the retail sector average, which can be taken to represent Oyowood sectors. So we have Oyo Wood and the sector average. The first ratio we have here is return on equity. For Oyo Wood, which is including director's loan account. For Oyo Wood, we have 71%, 47.1%, and sector average is 22%. Net asset turnover 2.36 times for Oyo Wood, and for sector average we have 1.67 times. Gross profit margin we have 35.7% for Oyo Wood. For sector average we have 30%. Net profit margin for Oyo Wood we have 20%, and for sector average we have 12%. From inquiries, Chisom PLC has obtained the following information. Additional information 1. Oyo Wood Limited buys all its inventory from other family companies at a price which is 10% less than the market price for such goods. II. After the acquisition, Chisom PLC would replace the existing board of directors and need to pay remuneration of 2.5 million per annum. III. The director's loan account will be repaid by obtaining a loan of the same amount with interest at 10% per annum. IV. Chisom PLC expects the purchase price of Oyo Wood Limited to be 30 million and the net assets are equal to equity plus the loan. Required. A. As the financial analyst of Chisom PLC, we calculate the ratios of Oyo Wood Limited after making appropriate adjustments to the financial statement for notes 1 and IV above for 10 marks. B. Draft a memo for the consideration of the managing director of Chisom PLC commenting on the performance of Oyo Wood Limited for 10 marks, totaling 20 marks. I'm sure, sir.
Okay, thank you. So we are required that we should calculate the ratios for Oyo Wood after making appropriate adjustments to the financial statement for notes 1 to 4 here. So what are they talking about? So these are the ratios they want us to calculate. So what adjustment are they talking about? And who is Oyo Wood? So there is Chisom experience capital goods in recent years through acquisition and integration of other companies. So, okay, he wants to acquire Oyo Wood. Okay, so they give us accounts of Oyo Wood. Okay. And answer from the above financial statement, Chisom has calculated for Oyo Wood these ratios. Okay. Then I said from inquiries, Chisom has obtained the following information that Oyo Wood Limited buys all of its inventory from other family companies at a price which is 10% less than, okay. I think that's why they're asking us to recompute these ratios. Because from here now, it shows that the account of Oyo Wood, this ratio right now is not comparable to industry. It's not comparable to industry because from this information I have here, Oyo Wood is able to get items cheaper. Is able to get items cheaper than other companies in the market because it can buy from other family companies at a price which is 10% less. So what we can do is to increase its cost of sales by 10%. So it's to increase the cost of sales of Oyo Wood by 10%, just so that we can compare it to be comparable with other companies. That's what we need to do with this information here. And if he has any inventory any inventory balance because I can see gross profits, net profits. Okay, you don't need to adjust any inventory balance because it doesn't really affect anything. Yeah. Okay. So then I said after the acquisition, Chisom would replace the existing board of directors and need to pay remuneration of 2.5 million per annum. So that means this has to be considered because if he acquires Oyo Wood, he would need to, there will be an additional expense on this company relating to directors' remuneration. So you need to replace existing and need to pay them 2.5 million per annum. So this needs to be added to its costs. Also, the director's loan will be repaid by obtaining a loan of the same amount with an interest of 10% per annum. So is there any director's loan? Okay, there's a director's loan of 10%, which is interest-free. So they will need to repay it, and he has to obtain a loan of the same amount and he pays. So we need to calculate interest on loan and put it in the account. And Chisom expects the purchase price of Oyo Wood to be 30 million. Okay, that's the net asset acquired. And net asset are equal to equity plus loan. Okay, so for this one, we need to make adjustments to the financial statements for your wood. Adjustment to statement of profit or loss. Now let me say adjusted. For the year ended December 31st, 2022. And what was the sales? It's 75,000. And what was the cost of sales? You need to increase it by you need to increase it by 10%. Okay. This 70,000. So how much would this give us?
49,500.
49,500. So what's my gross profits?
20,500.
Sorry?
20,500.
2,500. Then operating cost is 7,000. Operating cost is 7,000. They would replace existing directors and need to pay remuneration of 2.5 million per annum. So there is director salary before of 1 million, and in addition to this, they want to replace them, and they will pay them off. They will pay this, at least for this year, 3.5. And that is 10,000, 10,500. Then they would take a loan and pay interests. So ordinarily, I'll have PBIT. Then the loan they will take, they will pay interest at the rate of 10%. And the loan is 10,000. Which is 1,000. So profit before tax, 9,000. Income tax expense is 3,000. Profit for the year, we have 6,000. Okay, so I've adjusted this. Now let me recalculate um the returns on equity. So first, returns on equity to be profit for the year all upon equity alone. And profit for the year as computed above, 6,000. Equity is 19,700. Can I include this? Is not equity. So what would that give us? What's 6,000 divided by 19,700?
2%.
Okay, 30.5%. Then my net asset turnover, that would be my sales divided by net assets. I think they told us what net assets should be. Okay, they say net assets are equal to equity plus loan. So equity plus loan. So what's my revenue? 70,000. Equity, 19,700. Loan, 10,000. So how many times?
One 1.01 times.
1.0.
01.
No, that's not correct.
Oh, sorry.
Because this is just 29,000 divided by 70. That's almost times 2 point something.
2.35.
Okay. 2.35 times. Then we have gross profit margin, which is gross profits all upon sales. And what's my gross profits? This is 25 divided by 70,000. So how much is that?
29.28 times.
So let's say 29.3%. Then net profit margin, which will be profit for the year, over sales. So that will be profit for the year, which is 6,000 divided by sales, which is 70,000 times 100. What does that give us?
8.6%.
That's 8.6%. So that's all for creation of the MD of Shizom, commenting on the performance of Oyowood. So all we're just doing is just comparing what we have computed with this. Okay. Just to draft a memo form to like that. So I'll draft it and share it with you guys, because it's the same analysis we have been doing. There is nothing special for me, because I'll be comparing now 13.5% to 22 is still better than industry average. 2.35 times is still better than industry average. 29.3% still better than, no. Yeah, industry average is better, but slightly, a little bit. And that was because of this increase that we did to its cost of sales. Then the net profit margin, 8.6%. Industry average is better. And that was because of all these additional costs that we included, which affected its profit, which we're going to mention along the line. Okay, you have a correction?
Yes. Yeah. Please, is this safe to ignore the purchase price of that 13 million? it will not how do I put it now? So it's not impacting the net assets. Is that correct?
No, it's not.
The purchase price given.
No, it's not.
Oh, okay.
Yeah.
Thank you.
Yeah. You don't really need it for anything here because that's how much they want to buy this oil wood. That's how much Chisholm wants to buy them. That's the proposed price. So it has nothing to do with what we are computing here. We're analyzing oil wood. Okay, so you can also try your hands on this. Try your hands on this. And for me to know is if somebody reminds me and say, sir, you haven't provided solution for this one because I will send this is exactly what I've done here that I would send. So by the time you do the solution and you remind me, now it's okay. So people are actually doing it. So just try your best and get it done. This one. So this talks about said yeah, Solomon, I see your hand. Please ask a question.
Excuse me. I want to ask which one you want us to solve.
The B part of this May, November, this one, draft a memo.
Okay. Thank you.
So I've done the ratio, just do a memo, compare with industry average. So if you look at this May 2023, we have been asked that we should prepare a memo to the finance director explaining the ratios and highlighting the limitations of each ratio. So they want us to explain EPS and they want us to explain ROCE and also highlight its limitation. I think you should try this also as your assignment. I would also as well provide the solution. So we have looked at EPS, the definition, we have looked at ROCE. I'm not sure we mentioned anything around its limitation. So you can research on that. It has some very clear limitations. Like for EPS now, I know for sure that it does not consider capital invested. It just looks at profitability and it can easily be manipulated. Again, it does not consider inflation. So it's just EPS. You just say we have EPS of this. It does not really say much. It does not consider a lot of things. It's a major limitation. Even this one is strongly impacted by how you measure your assets because it's profit over capital employed. So a company using your depreciation policy and all of that can seriously impact what you get as ROCE, right? And again, your accounting policy choice also. A company using cost model and another one using evaluation model, with the same profits, they won't have the same ROCE. So it's a limitation in its calculation. And also, this can also be manipulated because there are some entity that might want to achieve a ROCE, a good ROCE in the short term, they will not do a lot of investments. All right, so they will have a denominator that is small, just so that their ROCE is okay, like that. So quite a number of limitations that relates to these guys. Just try your hands on this. So when I share this with you, the solution will not be there, but with it up so I can upload it with the solution for you when quite a number of you have attempted it. Okay. And the last question I want to look at tonight is this one. So this is talking about Ikoko PLC. So they gave us a statement of profit or loss and a statement of financial position. Now, they ask us to discuss three signs which show that Ikoko is suffering from over trading during the year from the published account. So from this account, what are the three signs that this company is suffering from over trading? I taught you this that day when I was teaching you ratio. So you will see this sharp increase in revenue. It's very sharp. It's almost X, it's more than X10. It's close to X16, like X18. So revenue increased by 18 times within 1 year. That's a sharp increase, right? And again, if you look at interest, serious, even this operating expense, interest, if you look at these taxes, serious increase. Unfortunately for him, if you look at his bank, this is a sign of overtrading. Negative cash position. Okay. He's holding excessive inventory. It's a sign. He has invested heavily in PPE. It's a sign. But I mean, if you check his working capital, you definitely see that it will be in negative. If you do current assets minus current liabilities, what is the current asset now? 200 plus 70, 270 minus 50, that's 220. And this is 190, 50, this is 240. So it's a negative 20. But they just asked for three signs. So there are a lot of signs here that is showing that this guy is over trading. Signs from all these sharp increases, there are signs, negative working capital signs, and all that. So what are the causes of what usually causes it? So number one cause is excessive borrowing. When a company does excessive borrowing, when you're borrowing too much to finance your operations, it becomes a problem. And from here, if he was doing long-term borrowing, there is nothing, it's still okay, but he's doing a lot of short-term, so he's relying heavily on trade payables and bank overdrafts. So it's one of the major causes of overtrading. Number two is when the company is not well capitalized. So when you're doing your capital is 60 and your asset is 300, you're not capitalized, you're not well capitalized. You might end up over trading because your whatever activities you want to do, it will not be properly financed, so you'll be depending on excessive borrowings. Number three, another cause is when an entity is buying too much assets, making it to holding too much inventories. Also, is also a cause. And I think that they also mentioned the solution to you. You should sell assets, employ a factor to recover its receivables, inject capital to the business, try to negotiate reduce interest with the banks and see if they can give it some opportunities and all that. So all that are ways with which you can reduce, with which you can solve this problem of overtrading that he has actually found himself in. So all that will help him. So just you check your notes, and from this account this gives you some practical insight into over trading. So this is a question of November 2020. Okay. So we're going to stop here for tonight. We'll continue next week. And next week, we are going to do sustainability reporting next week. I want to get it out of the way. And this IFRS 18, I want to get those two out of the way. And if there is any other thing we're going to look at, then in the evening, we would we'll start IAS 12. And the way we are going to be doing our classes now, in February, next week is actually February. I'm supposed to use the whole of February to teach you group accounts. I want to finish up group accounts with you guys. So we'll be using evening periods, this period now from 8:30 to 10:30 or 11, majorly 10:30 for me. So we'll be using that for group accounts. So I want to take group account out of the way because while the first period I'll be using that to focus more on the accounting standards. And before I even jump to accounting standard, I want to take out statement of cash flows also. So see, what I'm trying to achieve for you guys this diet is I want to take out things that by the end of February, I want you to be able to look at your past questions and be happy with yourself. Right? So which is why I'm teaching you things you would find commonly, things that are all around your exams. So before you go, let me show you again. Last diet questions. Let me show you last diet question. Okay, sure you can see my screen. So this last diet question. So yeah. So last diet, the first one they showed the student was to talk about retrospective application of accounting policy, IAS 8. So we taught our students, I'm not sure I mentioned limitations. So, I mean, they're supposed to go in there and figure it out themselves. But I know we talked about retrospective application, but we didn't talk about limitation. Okay, but they can figure it from our discussion. But when we get there, we'll see. I will ask you and see if we can come up with anything. So they will discuss, but limitation, it now takes you to be able to think, to get your additional 2.5 marks, right? And the B part, yeah, the normal ones, 30, this 12, 5, 17, 25. Yeah, they ask this every diet, so this published. By March, I should start solving published accounts. We should have solved quite a number of standards. Then I should introduce you to published. We should start solving questions on published by then. Then, yeah, IAS 33 EPS. I really need to take this one also out of the way because they love it. They like asking it, really. You'll find it everywhere. So I need you to be able to look at this and be able to attempt it. IAS 40, yeah, much later. IAS 12, I'm probably teaching this. I'm supposed to is like the next thing on the budget. I just if I wanted to take it today, but I didn't want to be teaching like rushing to cover the syllabus, which is not how to pass an ICANN exam. It's not about rushing to cover. It's about, like I've told you, is reading with depth if you read a topic, don't just read a topic that you just read and you think you have. No, you read. Don't rush to live in that topic. Solve past questions like the way we are doing. If we can sustain this momentum and you guys are doing my assignments, you're following up, there's no way you will not pass. Because on every topic we are doing, we are going deep into solving, exposing you to many questions. And it's just not any question, your past questions. So which is likely what they would repeat. So now this one, IS 21, hopefully we'll have the opportunities. This is in your syllabus, apparently. So 5 marks is quite. Then ratio, we solve this in the afternoon. This question 3. We computed all of this and we saw that this is actually simple. Then there was cash flows there. There was cash flows. Then the question 4 was on group accounts here. So group account is an optional part of your syllabus. If you want to, fine. If you don't, you can just leave it out. It's not a compulsory correction, but I want to be done with group accounts by God's grace in February. I want to start and finish it within that month. I don't want it to leave. I don't want it to follow us after the half of the diet that you have. No. I want to be done with it by February. Yeah. So section C. Now here, for those of you that did not do my assignments, if my student last day did that assignment I gave you, this is it. So they said the methods by which accounting standards are developed differ considerably through the world. It is often argued that there are two main systems of regulations that determine the nature of accounting standard, rule-based and principle-based. Explain differences between the two systems and state which system is most descriptive. All they are asking here is talk about rule, and we discussed it. I gave you assignment on the advantages and the disadvantages. That's what you're going to play around here. Just to talk about the advantages of one, the advantages, like just to give few points on them, and you can leave away this. Okay. So again, advantages of adopting IFRS. So this is like advantages of a principle-based reporting system. That's what they're asking here. And sustainability. So I want to teach you sustainability reporting next week. You see here it's 15 marks. So like I always tell you, regulatory framework and conceptual framework alone, if you had, for those students, if they had read it, this part would have given them like maybe 25. Somebody can get 25 over 30. If you get 25 in section C, you have passed now. What is remaining? You're looking for 25 marks to go. The ratio is there. There's other things, I mean, so you don't want to joke with this part I'm teaching you now. They are so important. Then if you look at question 7, which is section C, they said identify and explain, giving practical examples, 4 fundamental principles set out in the ICANN code. I taught you ethics in reporting. So I taught you fundamental principles here. And they said, explain 4 categories of threats. We already discussed threats to fundamental principles. So, in fact, this one is even better. So it's even easier. Now, they says, discuss the merits that companies, accountants, and auditors derive from deploying AI and robotics in their business operations. This one is in your notes. So I told you rules of technology in reporting. That's the answer here. Whatever name they call that technology, whether machine learning, whether whatever it is, that rules, that is and it's just 3. So So this is technology and reporting like that. So these areas we have done, please prioritize them. Oh. That's why I'm teaching it early because we are now going to enter a part of that most of you will find challenging, accounting standards. I'll be doing double entry, doing all of that. As much as they are important, you have other areas that can equally make you do very well in the exam, especially this section C. So don't play with regulatory framework, don't play with conceptual framework, don't play with ethics in reporting, don't play with technology in reporting. Sustainability reporting that I'm going to be teaching you, we have done ratios. These are things you find almost every diet in the exam, right? So yeah. So I mean, you would have options just for you to there's that